What alternative investments protect against market downturns? Imagine a safety net woven into your investment plan, ready to catch you when the market takes a tumble. That's what certain alternative investments aim to do. They are assets outside the usual stocks, bonds, and cash, designed to add resilience to your portfolio. These assets often don't move in lockstep with traditional markets, giving you a buffer during economic stress. While no investment can guarantee zero losses, some have a history of holding up better when the economy weakens. Diversification is key here. By including alternative investments, you spread your risk across different types of assets. This means if stocks drop sharply, your other holdings might stay steady or even gain. For example, commodities like gold or agricultural products tend to perform well when inflation rises or currency values fall. Real estate can also act as a shield, as physical properties usually don't fluctuate as wildly as stocks. During downturns, rental income from real estate can provide a steady cash flow, and property values often hold better than stocks in tough times. Another option is commodity trading advisors. These are specialists who use systematic strategies to trade futures in markets like oil, gold, or agricultural products. Over the past 40 years, they have often made money during major crises because their trend-following methods can profit from both rising and falling prices. However, performance varies among managers, so choosing carefully is important. Private equity and private credit are also useful. Private equity involves owning parts of private companies, which are less affected by public market swings. Private credit involves lending money directly to businesses, often with fixed interest payments. These assets tend to be less liquid but can offer higher returns and less volatility compared to public stocks and bonds. During downturns, private credit can provide a reliable income stream, while private equity may temporarily decline but recover over time. Commodities like oil, gold, and farmland are often seen as safe bets during inflation or currency devaluation. They tend to rise in value when the cost of goods increases. Niche assets like fine wine and rare whiskey are less connected to traditional markets. They can appreciate over time, especially if supply is limited and demand remains strong, adding another layer of diversification. Liquid alternative strategies, such as hedge funds and certain mutual funds, give investors more flexibility. They can quickly adjust their holdings to respond to changing market conditions. These strategies often perform better than traditional investments during periods of stress because they can adapt rapidly. To make these work for you, consider allocating a portion of your portfolio to alternative investments based on your risk tolerance and goals. Always keep an emergency fund to avoid having to sell investments at a loss during downturns. Regularly review and rebalance your holdings to stay aligned with your financial plan. Using dollar cost averaging when investing in alternatives can also help smooth out volatility. In the end, assets like commodity trading advisors, real estate, private equity, private credit, commodities, and niche collectibles can help protect your portfolio during tough times. Each has its own risks and benefits, so working with a professional can help you build a strategy that keeps your investments resilient and ready for whatever the market throws your way.